All right, thank you, everybody. Welcome. We are here to talk about the 2017 Tax Cuts and Jobs Act. And as hopefully you saw, this is the first session of two sessions that we're going to be having. This one focused on individual tax reform. We have a full room here in Minneapolis and also have some people in simulcast rooms here today and several hundred participants on our webinar. So welcome to all of you, however you are participating. We have four presenters here today, all partners in Dorsey's Tax Trusts and Estates Group. I am Tessa Mielke. We have here next to me Katina Peterson, Mary Streitz, and Ben Lindblad. Full bios and contact information are in the materials that you have, either in front of you or that you received in the program reminder. Just as a preview of what we're going to cover today, we will start with an overview of the individual income tax provisions in the new act, the new rates, as well as changes to deductions and credits. We'll have a brief overview of the new pass-through deduction, although that provision will be talked about in more detail in session 2. We'll talk through some of the estate and gift tax changes in the law, as well as a few other provisions of interest. And then we will talk more generally about the impact of the law when all of these different provisions are combined on various different taxpayers, as well as more general policy and political implications of the act. We will try to leave room for questions, but as you can see, that's a lot of things to get through. So please hold your questions until the end. For those of you on the webinar, we won't be able to take questions live, but you can submit your questions by email to dorseyu@dorsey.com, and we'll do our best to respond to those questions by email after the program. And with that, I will turn it over to Katina to talk about the individual income tax rates.
Thank you, Tessa. Brackets and rates seemed like a good place to start. So as many of you maybe know, the new act keeps the 7 bracket progressive system in place, but it does change the threshold levels pretty significantly, and it reduces almost all the rates. We still maintain the lowest rate at 10%, second to highest stays at 35%, but all of the other rates are reduced. The next 3 slides, just so you kind of know what we're comparing, the original 2018 brackets, that would be what we would have paid in 2018 had there been no Tax Act. And the new 2018 is the brackets and rates under the Tax Act. So the first slide we have up, married filing jointly. You can see the new rates and thresholds. One interesting observation that we made, there are just certain interesting pockets within the brackets themselves. Here, income between roughly $238,000 and $315,000 sees a very healthy decrease in tax that moves from 33% to 24%, which essentially means if you're making joint filers with at least $315,000 of income are going to see roughly a $7,000 decrease on that tranche. The next, single individuals, and as you can see, we no comparable savings. We don't see that for single individuals. In fact, for singles are moving up to the second to highest rate, move up to the 35% rate, much, much faster than under the old rules. So now, starting at $200,000, we're moved up to 35%. Before, you're not moving up to 35% until roughly $425,000. This means that taxpayers within certain levels of income there may see a tax increase if we're just looking at rates in isolation. This isn't factoring in credits and other things like that. This also interesting about this, the single brackets are now exactly double the married filing jointly brackets, or excuse me, married filing jointly is exactly double single brackets, which effectively eliminates the federal marriage penalty for all categories of income earners except those making a combined $600,000 to $1 million. So except in that top bracket, the marriage penalty for ordinary income is effectively eliminated. Finally, we have head of households. Similarly, no, we didn't see any big tranches where we found tax breaks like we did with the married filing jointly. Instead, we did identify here, sort of interesting, in the between $200,000 and $216,000, we're going to see a 7% increase for that tranche of income for head of household filings, moving from 28% up to 35%. So all of these rates, like most of the individual income tax provisions, sunset on December 31st, 2025. The brackets will continue to be adjusted for inflation. They've been adjusted for inflation since the mid-1980s, and that's to prevent something called bracket creep, where you're moving into a higher bracket not because you're really making more money, but really because of inflation. So in order to prevent that, they indexed the thresholds to inflation in the 80s, and that's going to continue, except that we're going to use a new measure of inflation. It's going to change. We've been historically using consumer price index for urban consumers to adjust bracket thresholds. That's going to be replaced with something called chained CPI, chained consumer price index. Economists, I mean, it seems relatively clear this is a more accurate measure of inflation because it accounts for consumer substitution behavior, meaning, you know, if the price of oranges goes up, more people will start to buy apples. But because inflation, the pace of inflation will grow slower, the brackets will expand a little bit slower, and therefore we'll start to move into higher brackets faster than we would have under traditional CPI. So what that means when they kind of project these numbers out, in the first couple of years, barely noticeable, you know, on the grand scheme of things, but over the next decade, the projections are this change, going from traditional CPI to change CPI, is going to generate about $134 billion of revenue over the next decade.
And that's $134 billion of revenue compared to what would have been
Right.
collected in those later years under
Right.
the old way of doing it.
Right,
So it's not necessarily going to mean that people feel that
right,
because they never got to that year under the old system.
right.
But it is something that is going to produce more revenue
Right,
over time.
and it's permanent. So unlike the sunset for most of the other income, you know, this change is going to be permanent. It doesn't sunset. Next up, alternative minimum tax. You know, repealed for corporations, but individuals were not so lucky, so the AMT was retained. The complex system for calculating AMT is in place, but some very positive changes for taxpayers is the AMT exemption amount went up by a substantial amount, and the threshold at which the exemption starts to phase out went up by a very healthy amount. So you can see married filing jointly was at roughly $161,000 for when it started to, the exemption starts to phase out, and that went all the way up to $1 million. This means many less people will likely be subject to AMT, and those that are will likely pay less. No changes for trusts and estates. The AMT remains as it was, and for corporations it was repealed, which likely will be discussed a little bit more in our next session. The Kiddie Tax saw big changes too. So Kiddie Tax, unearned income of kids under 19 and full-time students under 24. Under the old rules, we looked at the parents' income tax rate and brackets. New rules, we're going to look at the trust and estates brackets and rates, which means we get to a much higher bracket very quickly. So we get to the 37% bracket at $12,700. This is likely, I mean, although it probably isn't gonna cause big changes for high-income earners who are gonna get to those high brackets anyway under the old system, I think for low to middle-income families who the parents' rate, maybe their rate's, 10, 15, 22%, now if they have kids who have unearned income at, 9 to 12,000, they're at 35%. Anything over 12,700, they jump to the 37% rate. So that's going to be a revenue raiser in that sense. Finally, no changes to the rates or thresholds for these three categories of income: long-term capital gains, qualified dividends, and the net investment income tax. It's a little strange. We still use the old thresholds to calculate, the rate at which you will pay long-term capital gains. We're not using the new thresholds at which our ordinary income is calculated. So things are not going to line up perfectly on this. Commentators are speculating we may see a change. And it also means that for these categories of income, the marriage penalty, the federal marriage penalty would still exist because we're looking at the old thresholds for that. So with that, we are going to move on to deductions and credits, which Mary will discuss.
Well, a lot of these have been discussed in the press, in the lay press, because they're fairly easy to understand and grasp. The standard deduction is increasing substantially. The press has usually described it as doubling, but it isn't quite doubling. The 2017 amounts are shown in the left-hand column, and the 2018 amounts are shown in the right. And normally, there'd be some bump from 2017 to 18 under the old system. So the doubling is going to be a little bit more compressed by 2018. What this will do is lead fewer people at the margins to itemized deductions, thereby promoting simplification, I guess. The personal exemption, however, is being eliminated, and this is something that may be more beneficial to people under current law than doubling the standard deduction is beneficial under the new law. And the personal exemption elimination means that taxable income will go up by the amount that would otherwise have been taken off and resulted in the personal exemption deduction. This has a bigger impact the bigger your family is, obviously. Under current law, though, people at higher incomes had their personal exemptions phased down to zero above certain income levels. So this has the greatest impact on lower to middle income people, potentially. The child tax credit will be substantially increased. So this will be sort of the counterpart to eliminating a personal exemption, which could have been taken before for a child. And now you have an increase in the child tax credit, which reduces your tax dollar for dollar, and in fact, up to $1,400 of the new credit is refundable, so that even if you don't have any tax liability, you can get up to $400 back per child from the federal government just for having a child. The child tax credit is going up from $1,000 to $2,000, and the threshold at which the credit starts to phase out has been bumped up very dramatically, particularly for married taxpayers. You can see in the chart that the threshold goes up to $200,000 from $75,000 before it starts to phase out for singles and head of householders. And then it'll be totally phased out at $240,000 of taxable income for those taxpayers, or AGI. And then for married, it goes all the way from 110,000 to 400,000 and is fully phased out by the time someone's AGI gets to 440,000. This credit is only available for children or other qualifying children, that could be a child or any other number of people, but they have to be 16 or under at the end of the tax year, as under current law. There is also a new non-refundable credit of $500 introduced into the law for non-child qualifying dependents. That could include, for example, a parent, if you're supporting a parent who lives in another household. This is a big one that's getting a lot of attention, partly because of its reverberating effects on state tax systems as well. But this is the deduction for state and local income taxes for those who itemize. It used to be unlimited. You could deduct all your income tax and all your property tax paid during the tax year, not your sales and use tax and other taxes if you're a non-business taxpayer. But those two taxes, income and property taxes, are typically the largest ones. And in the high tax states especially, produce very significant deductions. That deduction is now going to be capped at $10,000. Whether, and that is regardless of your filing status. So individuals, heads of household and married joint will all be subject to that same limitation. That limitation will not be indexed for inflation. Other changes on the Schedule A for those of you or your clients who itemize, the mortgage interest deduction will be limited in ways that could be quite significant. Now, for new mortgages entered into after December 15th of 17, the maximum amount of mortgages on a first and second home for qualified acquisition indebtedness can only be $750,000 of such indebtedness instead of $1 million. Existing mortgages are grandfathered, so that if you have one of those with a higher, you get to keep your $1 million limitation for mortgages that predate those dates. Home equity mortgage indebtedness, though, is now canceled. No more of that unless you're in the odd circumstance that home equity indebtedness is acquisition indebtedness. Most people maintain those lines to deal with cash flow needs, and therefore they wouldn't be in that category, and so that is all going away. Moving expenses deduction is suspended, and employers will not be able to reimburse employees for moving expenses on a tax-free basis under this change. Of course, there's an exception for certain members of the armed forces who are in active duty and ordered to move by a military order. The alimony deduction is eliminated. That probably was seen as an income shifting device and was seen as a way to raise revenue because the higher income taxpayers who are paying alimony and shifting that income to a lower bracket can't deduct it anymore. That could affect negotiations regarding the amount of alimony, and existing alimony agreements are grandfathered. This change is permanent. I think it's the only one I'm mentioning here that doesn't go back to the old rules after 2025. The charitable contribution deduction is slightly increased. You can make cash contributions up to 60% of your AGI instead of 50%, but the deductions will be worth less because tax rates have gone down, in general. So charities are worried about the implications of this new law for charitable giving behavior. This maybe, offsets that a little bit. There's an elimination of a tax break for people who paid for the right to purchase tickets to college athletic events with a donation. Under old law, you could get 80% of your deduction if it was at all linked to giving you a right to produce tickets. Now that goes away. There's a lower floor for 2 years only for deducting medical expenses, back to the old 7.5% of AGI threshold that was part of the law for many years, but it will kick back up to 10% in 2019. The 2% floor miscellaneous itemized deduction category is going away. Those are the deductions that employees could take for unreimbursed employee business expenses, investment expenses, tax preparation expenses, and home office expenses. For some taxpayers, those expenses did exceed the 2% floor. I've worked with taxpayers who deducted attorney's fees, for example, when they had to pay an attorney to recover in litigation a lost investment. And sometimes those attorney's fees are rather large. And so the clients could deduct the excess over 2% of AGI that they paid in fees, but no longer. The overall limit on itemized deductions has gone away, as it did during the economic downturn years. Higher income taxpayers under prior law had their personal their itemized deductions phased down above certain income levels. That goes away, as it did during the economic downturn. But again, because the value of the deductions is less with the lower taxable income, it may be just something that results in simplification rather than great savings. And as I mentioned earlier, these are all gonna sunset after 25. You're gonna go back to the old way of doing things, rate-wise, and deduction-wise, and personal exemption-wise, except maybe for alimony. Other than, that's the only one that's permanent.
So now we're going to take a few minutes to talk about the new qualified business income deduction. This is also sometimes called the pass-through deduction or the 199A deduction. We've received a lot of interest from folks on this because it's brand new. It's something that's never been in the code before, and it's also very complicated. And so it has taken tax professionals and others the last couple of months to chew through it and really understand how it's going to work. The deduction itself is 20% of qualified business income. It's available to non-corporate taxpayers, so basically individuals, trusts, and estates, on their qualified business income, which is in essence ordinary income from a pass-through business, whether it's a partnership, an S corporation, a sole proprietorship, including an LLC that's wholly owned by an individual. It doesn't include wages. It doesn't include guaranteed payments from a partnership or capital gains. It also doesn't include interest or dividends or certain other items that wouldn't constitute ordinary income. Also, any income that's not effectively connected with a U.S. business. So if you have income in, say, a foreign partnership, it may not qualify for this qualified business income deduction. There's a number of terms within this provision that need regulations to put some meat around. One of them is, what is a trade or business? As often as it's used in the tax code, trade or business is not defined, including for this purpose. And because it's used differently depending on where in the code you are, there is a lack of clarity right now about what will or will not constitute a trade or business for purposes of this deduction. What we do know is that unlike some other areas of the code, an employee or being an employee does not constitute a trade or business for purposes of the deduction. The deduction is limited in a number of ways, but the most important of these is the 20% taxable income limitation. So your 20% of qualified business income deduction is going to be limited to 20% of your taxable income less net capital gains. This limitation applies to a couple of other categories of income that are also entitled to a deduction. Income from a publicly traded partnership or REIT dividends are also subject to this limitation. It's not applicable to qualified cooperative dividends, and there is a lot of interest in the agricultural space around this deduction because it applies quite differently to those businesses. One other important piece here, that taxable income it's important to understand that that's not your gross income, it's not your adjusted gross income, it's taxable income, which means your HSA contributions, your 401k contributions, your standard deduction if you take that, your itemized deductions if you take those, all of those are used to reduce your taxable income. So the limitation is actually going to be quite a bit lower than your top line income for the year. There are two other limitations that apply depending on whether or not you exceed certain income thresholds. The first is a wage limitation threshold that applies over $315,000 of taxable income for joint filers and $157,500 for everyone else. That wage limitation is 50% of your allocable share of W-2 wages. An allocable share, if you're a partner in a partnership and you have a 1% partnership interest and you are generally allocated 1% of the wage deductions of that partnership, it means that your allocable share of the W-2 wages is also 1%. So it could be a very significant limitation depending on what your interest in the business is. It's either 50% of your allocable share of W-2 wages or 25% of your allocable share of W-2 wages plus a percentage of the basis of the business. This deduction phases in over $315,000. So between $315,000 and $415,000, you will be subject to a portion of the W-2 wage limitation. Above $415,000, it comes into full effect. So if your 50% of W-2 wages is less than your 20% qualified business income deduction, it's going to be reduced to 50% of W-2 wages. Perhaps the more important limitation for folks in this room and folks that you deal with is the specified service trade or business limitation, which is an additional limitation that's imposed on top of the W-2 wage limitation and the taxable income limitation, and that effectively phases out the deduction entirely for folks with income from a specified service trade or business once they hit that $415,000 threshold for joint filers or $207,500 for other filers. Specified service trade or business is defined to include the laundry list of folks you see there, very typical service businesses including investment brokers, traders, law, health, accounting, consulting, et cetera. What isn't clear is where exactly you draw that line. And so another point that we're hoping to get some guidance on is what are the four corners of a specified service trade or business. That's likely to take quite a while to develop. This deduction, like the deductions that Mary just walked through, also sunsets at the end of 2025, which is putting us in an interesting position. This deduction really helps to address the disparity that would have otherwise occurred because of the 20% corporate income tax rate. And so for the time being, the decision of whether to incorporate your business or have your business as an S corporation or a partnership is a close call. If this deduction is allowed to phase out at the end of 2025, it's going to be a very different calculation because now we're back up to the rates that are otherwise applicable to your income for all business income, and it may at that point cause some folks to rethink their entity organization. All of that we're going to talk about in a whole lot more detail in our second session at the end of February.
All right, we'll talk a little bit about the estate and gift tax changes in the new act. The primary change is that the estate, gift, and generation skipping transfer tax exemption was doubled. In 2017, the exemption was just under $5.5 million per person. And for 2018, the IRS has not yet released final numbers for what that exemption will be with inflation increases built in. But we are anticipating that it should be around $11.18 million. The exemptions, like a lot of the individual income tax changes, will now be increased for inflation using the new chained CPI inflation measure that Katina described earlier. So we would expect that going forward in the future that exemption amount will decrease at a slightly lower pace than it has in the past. This change, like many of the individual changes, also sunsets after December 31st, 2025. So we are left in an interesting situation with anticipating the future. So what do we do about this? A few things. First of all, revisit or encourage your clients to revisit their wills and their trust agreements. There are many wills and trust agreements out there that have been drafted with what we call a formula clause that differs where assets are directed based on whether they are subject either to state estate tax and or federal estate tax. Minnesota has also had significant changes in its estate tax and the exemption amounts over the last 5 years. As recently as 2013, the Minnesota estate tax exemption amount was only $1 million. For 2018, it's at $2.4 million, with scheduled increases over the next 2 years until it's $3 million in 2020. But with this federal increase, we are left at this point with federal estate tax applying to many fewer estates. So the federal estate tax was expected to be subject to, or about 5,500 estates per year were expected to be subject to estate tax with the former law, which is about 0.2% of the population. We're now at expectations of about 1,700 estate tax returns per year, so less than 0.1% of the population. But there is still, even for individuals who are not going to be subject to the federal estate tax, there are still significant planning concerns. As I mentioned, state estate tax exemption amounts are frequently lower than the federal exemption. There are a few states out there that have matched the federal exemption, so we will see what they do now that it's such a big increase. But Minnesota, as I mentioned, is $2.4 million in 2018. One other note, the federal exemption has a feature built into it called portability by many people that allows a married couple to basically pass their unused exemption when the first spouse passes away to the second spouse to use that at their death. Essentially, that allows you to use both spouses' exemption amounts more easily with doing a little bit less planning. However, many states, including Minnesota, do not have that feature built into their state estate tax laws. So in Minnesota, if you have a married couple who has, say, $5 million, if you don't do any planning and everything passes to the surviving spouse at the first death, you're going to have a significantly higher state estate tax bill at the second death if you don't do any planning than you could have if you had planned for that. Planning ideas in this new landscape for individuals who are subject to or may be subject to the federal estate tax continue to be similar to planning ideas that have existed in the past in many instances, including lifetime gifts, either to individuals or to lifetime trusts. The increase in generation skipping transfer tax exemption opens some possibilities for allocating that exemption to prior gifts for people who have made those. With the significantly higher federal estate tax rate, though, we are seeing a lot more situations where instead of saying, how do I avoid the federal estate tax, people are saying, you know, there's a benefit to having assets be included in your estate at your death, which is that for income tax purposes, those assets receive a change in basis to the fair market value of the assets at the individual's death. Typically, we call that a step up in basis because assets have a tendency to appreciate over time. It could also be a step down. But for people who have, say, an existing trust that was created in the not too distant future or not too distant past when the estate tax exemption was much lower, they may have a trust that is designed to keep assets out of their estate because nobody wanted to cause them to incur a 40, 50, 55% in the past federal estate tax on those assets. Now, if you have a beneficiary of a trust who that trust is designed to keep the assets out of their estate, but they wouldn't be subject to the federal estate tax if that trust was included, from a tax perspective, it may be better to have those assets included in their estate. They're not going to pay estate tax on it, but they would be able to get a step up in basis. So we're seeing a lot more planning around income tax consequences. Now, of course, before you do anything about that, you have to think not only about the income tax consequences and the federal estate tax consequences, also the state estate tax consequences, and non-tax considerations. If you're thinking about making a distribution from a trust, there are a lot of benefits to a trust, for example, creditor protection, that you can lose if you distribute assets outright. So certainly something to think about for people who have existing trusts out there, but make sure that you think through all of the consequences before you do anything. As we look forward, we are back in the same situation that we were in not too many years ago when we faced this sunset of the increased exemption. The estate tax exemption, the federal estate tax exemption, has never gone down. It's only gone up in the past, 2010 excluded. So it's not entirely clear what would happen if the estate tax exemption went down. There's some commentators wondering, you know, could there be a clawback of exemption that was used during life if you pass away after the exemption has gone down? Seems unlikely, but we don't have any guarantees right now. And finally, we have the estate and trust income tax rates. Those have changed a little bit to align with the new rates for individuals, but still the same $12,700 amount gets you to the top bracket. One note on deduction of expenses, some of those deduction changes that Mary talked through earlier impact estates and trusts. In particular, a common deduction for trusts would be investment advisor fees, which are no longer able to be deducted. There are, though, certain types of deductions, types of expenses that trusts can deduct despite that change. Those include trustee fees and attorney fees, which a lot of trusts encounter.
So before moving on to, later in our discussion, we have some tax impact slides and some policy slides, but before we get into that, we pulled out a handful of other provisions that we thought would be of interest. This is a tax deduction issue relating to sexual harassment settlements. And this provision is a direct response to the Me Too movement. And it was very much an attempt to try and have settlement agreements relating to sexual harassment be transparent and not subject to non-disclosure agreements. The language itself is going to pose some serious problems for both employers and for claimants. As you can see, it's incredibly broad, so no deduction. Under this chapter, that clause is important because it means, under this chapter means all of the income tax rules in the code, not just this particular provision. Any settlement or payment, which is undefined, related to sexual harassment or sexual abuse, which includes attorney's fees, no deduction is allowed for those payments if the settlement is subject to a non-disclosure agreement. It's going to apply to all payments made after December 22 of last year. And that could include, people think based on its plain language, it will include agreements that were entered into before that date, but a lot of times we'll make payments over the course of time, and payments may be made after that date. So the agreement may already be what it is for some people. Some of the more significant problems and uncertainties, the language itself is so broad that it's very unclear what would happen with, for example, a multi-claim suit. A lot of the times, a claimant will bring multiple claims. And if one of the claims is sexual harassment, if sexual harassment is alleged in the complaint, do all expenses relating to the entire claim as a whole, is that what we're talking about here, or is it more narrow and refined than that?
There's a body of law on allocating settlements to
Right.
claims, and don't you think that would come into play?
Yes, and that's actually, we have in your materials we did an article on this particular issue, and there are planning considerations like carefully allocating that are all listed in more detail in your materials. The big unintended consequence that's getting quite a lot of press is the language applies to deny deduction to the claimant's attorney's fees if the claimant could otherwise deduct those attorney's fees under the code. A plain read of this language would disallow those deductions as well. If Congress can, put together a technical corrections bill, commentators are hoping that this may be one of those on the top of the list where we need to not only get guidance from the IRS, but maybe make some technical corrections to the language. I think it was just meant to be broad, but it's broad in a way that's so unclear, it's going to be difficult.
You can also posit that the plaintiff might want
Correct.
privacy.
Right. It wholly disregards that in a lot of situations, for a variety of reasons, the claimant may want confidentiality. So then you've got this situation where claimant wants confidentiality, and if employer provides confidentiality, employer doesn't get the tax deduction. And that we've seen, most of the time, both parties prefer confidentiality in a lot of agreements for a lot of different reasons. And it overlooks that. It's drafted so that if there's a non-disclosure, it's a punishment in the form of denying a tax deduction. So.
All right, a couple of other provisions that are just interesting. The Affordable Care Act changes, may have heard about this. The individual mandate that imposed a tax penalty on people who did not acquire health insurance has been repealed starting in 2019. So in 2018, you still need to have health insurance that meets the requirements or you'll face a penalty, but beginning in 2019, that penalty has been set to 0. There's a lot of speculation about what this will mean. Most people believe it will mean that fewer people will sign up for health insurance, fewer young, healthy people will sign up, which could drive up premiums. But the exact amount by which premiums could increase is uncertain. This is still sort of an experimental provision. I've seen estimates of maybe 10%, but it's really just estimates at this point in time. One thing that has not always been publicized when this change has been discussed in the media is that the rest of the provisions of the Affordable Care Act remain intact. So the state exchanges and federal exchange remain open for purchasing insurance. The subsidies to individuals who are deemed to not be able to afford premiums remain in place. And so even as premiums increase, those subsidies would increase as well. And similarly, the requirements for employer insurance in the Affordable Care Act remain. Another one is 529 plan changes. So many of you may be familiar with 529 plans as a tax-preferred method that has been for saving for college education expenses, as a tool where the income inside of that plan is not subject to income tax as long as the assets in the account are used for permissible expenses. The Act expanded the permissible expenses that those accounts can be used for to include $10,000 per student per year for elementary and secondary school education, rather than only post-secondary school education. That must be used for elementary and secondary school tuition as opposed to other expenses. But it is a significant expansion, and many states, including Minnesota, offer tax benefits for contributions to 529 plans. So this can be a really effective way for reducing taxes for people whose children are in especially private primary and elementary schools. The one note on that from a gift and estate tax planning perspective, contributions to 529 plans, you should be aware, are gifts for gift tax purposes. So if you're thinking, well, because of this change, I'm now going to kind of front fund all of my kids' education amounts into a 529 plan so it can just sit in there and grow tax-free, be aware that there is a gift tax filing obligation if you put in more than $15,000 per individual per beneficiary. You may not have to actually pay tax, but you have a filing obligation.
Does that mean it would be viewed as a gift, even though a parent has an obligation under law to support a child? That doesn't make sense.
Yep, but there we are. It is a gift.
Okay.
If you pay tuition directly, you're not subject to gift tax laws. So this is sort of a weird workaround, because it used to be that it was broader than only paying tuition in a 529 plan. And then I will turn it over to Ben. We are going to, in the impact section, kind of talked about the differences, the different impact in different tax years, because as you can tell, there's a lot of changes over time. So we'll start with the current 2017 year.
Thanks, Tessa. So as Tessa said before, we start looking at 2018 and after and the impact of all of these changes for tax planning. We wanted just to take a couple of minutes to talk about the tax planning opportunities that arose between the bill being signed on the 22nd of December and the end of the year. Some of these you probably either participated in yourself or read about them in the press. One tax planning opportunity, and this actually may come up again, and I'll talk about that in just a second, but because of the change in the standard deduction, there will be a significant portion of taxpayers that are no longer itemizing deduction, which creates an incentive at the end of 2017 to accelerate deductions that would otherwise be itemized to make use of them. That'd be charitable donations up to 50% of your AGI, and the interest portion of your mortgage, and for 2017, home equity payments. The mortgage interest payment, unless you're deferring interest generally, is probably pretty limited. Really limited to, if you had a payment that was due in January of 2018, could have made that interest payment in 2017. Charitable donations, though, there was a lot of concern among charitable organizations about, as other folks mentioned, the loss of the itemized deduction and the benefit that relates to that. And one of the planning opportunities was to accelerate those donations into 2017 to increase your itemized deductions. The reason that I said that it'll continue to be an issue is that to the extent that you are close to that threshold between using the standard deduction and itemizing your deduction, you may want to consider bunching deductions. So planning to use itemized deductions in one year, flipping back to the standard deduction in the subsequent year, and flipping back and forth. And the way to do that is exactly as we've listed here, to make all of your charitable donations for a 2-year period in 1 year, and then make none in the subsequent year to drive up your itemized deductions in that first year, and then just use the standard deduction in that second year. The other, and this is the one that really hit the press, is Congress saw coming by implementing the $10,000 SALT deduction limitation that folks would try to accelerate payment of state and local taxes into 2017 in order to take advantage of the uncapped SALT deduction in 2017. They addressed it in the act by limiting the deduction for state and local income taxes to the year in which the tax is imposed. In other words, 2018 state and local income taxes couldn't be prepaid in 2017 and deducted against 2017 income. What they did not address is property taxes. And so here in Minnesota, in Hennepin County, the county collected $122 million of prepaid 2018 property taxes in 2017, where in the prior year it was just $6 million. And what we saw were lines in the Hennepin County Assessor's Office of folks looking to prepay those 2018 property taxes. They were also taking payments online and in fact acted very quickly to allow folks to prepay those property taxes. However, at the end of the year, on the 28th of December, the IRS issued a news release, not published guidance, not a revenue ruling or treasury regulations, but a news release stating its position that the tax would be, property tax paid in 2017 would be deductible against 2017 income only if the tax was assessed in 2017, even if it relates to a 2018 property tax generally. And the question that leaves, assuming that the IRS's position is correct, and there's some question about that, but assuming that the IRS position is correct, what is an assessment for this purpose? And Minnesota provides a pretty good example. In November, Minnesota residents receive a truth in taxation statement. It says right at the bottom that this is not a bill. And so there's a question of whether that constitutes an assessment, probably not. But under state law, by the end of December, all tax assessors are required to certify and report to the state of Minnesota their final levies. And so there's a question of whether that constitutes an assessment for purposes of taking this deduction. It's a very complicated issue. It's an open issue. It still remains to be seen whether the IRS is in fact going to try to enforce this, given that they're going to have to look at what is or is not an assessment on a county by county, or at very least a state by state basis. And so there's a planning opportunity there to the extent that you did pay your property taxes for 2018 at the end of 2017, but it's an uncertain position at this point.
In Wisconsin, I do know, because I have a cabin, that the assessment for taxes payable in 18 does take place in 17. So, like you said, every state has a different structure to its law. Just some sort of generalizations about the impact of the federal tax changes on everyone's federal tax liability. The conventional wisdom, and this is backed up by some intelligent analysis and estimates, is that about 80% of individual taxpayers will see a federal tax decrease, 15% will stay about the same, and 5% will see an increase. There are certain people who have characteristics that make them more susceptible to being in the category of people who may see an increase. A couple of those are identified here on this slide. High earning single taxpayers and heads of households who live in high tax states when their income isn't qualifying for the new 20% pass-through deduction. I guess I might be one of those people because I'm a head of household. And this bullet suggests that those in that category may see an increase with AGI of around $200,000 or more. And then that would kick in for married taxpayers at a higher level and also be less likely for married taxpayers at 500,000. Conversely, lower to middle income taxpayers who under current law have high itemized deductions and lose those benefits because of the limitations on itemized deductions that are coming into the law may see an increase as well.
Yeah, and these really are, it's going to be dependent on each individual's or each household's particular tax circumstances. And so, when we talk about these people are most likely, that's going based on the changes in the rates, how we talked about, married filing jointly see much bigger decreases based on rates alone. But then, of course, the deductions and credits and the fact that the base of tax is broadened by those changes to the deductions is going to impact some people more than others. So it depends on the amount of your deductions, but also what those are. So that's why you see here, it's those who live in high tax states are, of course, going to be more likely to be hit with a tax increase because of that $10,000 state and local tax deduction limitation. And also what we may be hearing more and more about is how differently this law impacts those who earn their income from wages or from service businesses, like accountants and attorneys, where you're subject to this limitation on the pass-through deduction that Ben described. So it really is going to have to be a case-by-case analysis, whether you individually will see a tax increase or a tax decrease, but we wanted to highlight some of the more common situations that may see an increase, given that that is the less common situation.
And I did try to have some numbers put together to project under certain scenarios what was going to happen when you consider the combined effect on federal taxes and state taxes of the change in the law. And because some states may yet change their income tax laws effective this year, to respond to the federal changes, you can't really project what someone's state deduction is going to be necessarily, and trying to project how it's going to flow through on their federal return this year. I think this is mine too. So over time, because we have changes in the way the inflation is taken into account, the positive impact of the lower taxes will in reality be less compared to what they would be under the old law if you projected forward to these years after 2018. Similarly, the personal exemption under the old law was indexed for inflation, but the child tax credit stays constant. So those are probably two big ways that most suggest that over time the benefit of this law is not going to be as large as in the earlier years.
In the early years, right. On the state front, so our federal cuts are largely a product of rates going down. We're actually all going to very likely see larger federal taxable income numbers or federal AGI income numbers because of the elimination of the personal exemptions and itemized deductions. So our starting point might be bigger, but because the rates are lower, we're going to see a federal tax cut. But for states, so Minnesota is one of 6 states that starts with federal taxable income as its starting point. Other states start with federal AGI. For these states, where taxpayers will likely see a tax increase because we're not factoring in. This is largely a product of the elimination of the personal exemptions, and there's no child tax credit at the state level. So while a large percentage may see a federal reduction, many taxpayers, in particular in Minnesota, will likely see some tax increase. The next slide, this is Minnesota Center for Fiscal Excellence, is an organization that does a really fantastic job with tax modeling and analysis. They put together this modeling, this table, and it's actually part of a larger discussion. You've got a full copy of the discussion in your materials. The numbers are based, because they have to be based on a whole bunch of different assumptions, one of which is that Minnesota will conform to the new federal tax code. So this is showing, although we are seeing in the various filing statuses a healthy federal tax decrease, many filing statuses at different income levels are seeing a state increase. Most are seeing a net benefit, but the range of the net benefit varies pretty dramatically. The article points out a couple of the larger variations, one of which jumps out to me. So you've got married filing jointly at $150,000. The state tax increase that income filer is having, $288, that only swallows up about 7% of their federal tax benefit. And then you go up to married joint at $50,000 level of income. They're seeing a $224 state tax increase, which gobbles up, more than 60% of their federal tax decrease. That is going to start a lot of policy discussions, I believe, in Minnesota, because it's wildly varying your tax outcome, not really based on your family size or things that Minnesota has historically thought was important. And that's because largely, again, it's this personal exemptions are eliminated and there's no state level tax credit.
One thing I guess I would just point out, given that in Minnesota at least, and in other high tax states, our high tax states where the starting point is federal taxable income in particular, our state taxes will go up. And so you may want to consult your tax advisors about whether you should slightly bump up your state income tax withholding or pay some additional state estimated taxes to avoid penalties for late deposits and or surprises on April 15th. These numbers on this example aren't huge, but I see for married joint $250K, it is an almost $1,000 change that is projected for the average person in this category.
Right.
A few other potential effects in 2018 through 2025, and we've talked a little bit about some of these. Because of the increased standard deduction as well as the limitations on itemized deductions, we will probably see a lot fewer taxpayers itemizing their deductions. Estimates have been that may go from about 37 million households itemizing down all the way to 16 million households in 2018. As Mary mentioned, that has given a lot of charities some reason to have a little concern about charitable giving, and to the extent that people are giving to charities in order to obtain a deduction, or that is at least encouraging them to increase the amount that they give because they'll get a tax benefit correspondingly, charitable giving could go down. There's been a lot of people trying to estimate the impact of that, but of course it depends on people and what they're going to do, so no one knows for sure. But estimates have ranged from about 4% to 7% decline in annual charitable giving as a result of this change. One estimate was that for the charitable giving subsidy, if you view it as the federal budget giving a subsidy to charitable giving by giving a tax break for that, that will decrease from about $63 billion to about $42 billion. So that's quite a change. Also, you know, as the estate tax exemption continues to go up, that may also discourage charitable giving at death. There are certainly individuals who say, you know, I give the amount that I can give free of estate taxes to my children or to family, and everything above that to charity. With an increase from $5.5 million to $11 million, that's for every person who does that, and $5.5 million that's not going to charity. You may also see, you know, as the limitation on state income and property taxes goes into effect, that certainly brings state taxes to the forefront in a lot of people's minds. You know, they're no longer getting a federal tax benefit for making those payments. Could see people moving states as a result of those taxes, but you never know. The last one is the IRS budget. You know, this is obviously a huge tax change. The IRS has a lot of work to do to implement all of these changes. They've certainly started a lot of that work already, but there's a lot more to be done, and they're doing this with a significantly slashed budget that has gone down in the last 7 years, 18%, and they've lost 20% of their workforce. So getting a whole new tax bill to implement is certainly a challenge. So, you know, stay tuned, but that's one possible effect that we could see. Looking after 2025, when many of the changes, as we've talked about, sunset, certainly things get interesting. So you may think, you know, if the changes sunset, we go back to what we had before. Almost, but not quite. As we've talked about, there's a few things that survive. One of them is the inflation adjustment, as well as, of course, the corporate rate cut. And that impacts individuals as well if they own stock in those companies. We'll look at a slide next that talks a little bit about the quantifying those changes. But here, let's flip to that one. So you can see this slide was put out by the Tax Policy Center, and shows in several tax years kind of forecasted tax changes for people at different income levels. So the blue lines are 2018, the red line is 2025, and the yellow line is 2027 after the individual tax changes have sunset. So you see in 2027, the yellow lines are generally pretty small, other than continued tax savings in the top 1% and 0.1%, which are primarily from the corporate rate change. And you may or may not be able to see this, but the two lowest quintiles actually have a bar going downwards, showing that there would be a tax increase compared to current law. And that is primarily the result of the inflation change. Because you're starting at lower dollar numbers there, that inflation change makes a bigger difference in your overall taxes. And so those people in the lower income quintiles would see a tax increase compared to what they would have seen if this Tax Act had never come into place at all.
And I assume quintile refers to the number of people. So 40% of taxpayers
40% of
would see a decrease under these projections.
Would see a tax,
I mean, an increase,
tax
yeah.
increase,
Yeah.
correct. Yep.
A decrease in their after-tax income.
Right. All right, we're going to switch to talk about a little bit of the policy and political implications here.
Yeah, the consensus appears to be that the federal debt will go up by over $1 trillion over the next 10 years as a result of this legislation. Most estimates assume that the act will have relatively little effect on gross domestic product. There is uncertainty about the impact on gross domestic product because of the drastic cut in corporate taxes, which is really kind of unprecedented. And so it's hard to know what's going to be done. We've read about certain companies that have given bonuses or others that have bought back stock. You know, I think the ways that people will deal with that are as yet unknown.
So on the state side, this is sort of circling back to when I had the MCFE slide up and talking about policy concerns for states. It's not just Minnesota, pretty much any state with an income tax keys off of the federal code in some way, shape, or form. And that means because of the expanded tax base, they are going to be seeing increased revenue. The Minnesota Department of Revenue very recently released its preliminary estimates on increased revenue for a 3-year period. The estimate assumes that Minnesota will conform to the new federal tax code, so we will start, they're assuming conformity. Federal taxable income will be the starting place, and it'll be the new definition of federal taxable income. Projections are roughly $400 million of additional revenue in 2019, just related to the individual income tax changes. If we factor in all the corporate tax changes, it's over $7 million in each of 2019, 20, and 21. So for states, we're having this broader base, we're increasing revenue, and it's all happening because we're no longer taking account of personal exemptions and we don't have a child tax credit. So what are we going to do, and what do we think Minnesota is going to do, and what are other states going to do? Minnesota has been officially very, very quiet. So Minnesota hasn't come out and said, we think we'd like to do this for tax reform. I've had discussions with an assistant commissioner and some director level individuals, very clear that they favor conformity. They favor it strongly, largely because of the administrative nightmare it would be to decouple from the federal tax code at this point. But they also see that there will likely need to be conformity coupled with some other type of tax reform. And that's where the conversations are going to get interesting this session. And our legislative session doesn't start, it's a short session this year. It doesn't start until February 22nd, and it runs until mid to late May. So they're gonna have to be pretty efficient with things. And even the conformity piece isn't automatic in Minnesota, so states either have what's called rolling conformity or static conformity. We have static here in Minnesota, which means we don't automatically, there's not an automatic federal update. Anytime we want to match up with the federal tax code, we have to go in legislatively and say up to what date do we want to match up with the, federal taxable income piece of things.
So under the current law, federal taxable income is computed under the old federal tax law.
Right, for Minnesota purposes. Until we conform or we pass what Minnesota likes to refer to as the federal update, because they think that's more appealing to people, federal taxable income is calculated based on the old rules. So it's going to be an interesting session, and people are doing lots of different things. Vermont announced on Friday, Vermont's one of the other 6 that starts with federal taxable income. They announced on Friday they are going to change, and they are going to start with federal AGI, federal adjusted gross income, and then they're going to add in a state level personal exemption. I think other states, I think that seems like one of the more simple routes to go. I think adding a state-level child tax credit is probably another way to go, especially if policy makers are thinking we want to reflect household size in our tax liability. Then they're going to play with personal exemptions, child tax credits.
They would have to
things
do
like
something
that.
they'd have to do something with itemized deductions, though, or otherwise
the
the
thing.
base is so much higher.
Right, and for Minnesota, I don't think they will flip. This is pure speculation, by the way. Flip to federal AGI, because then they have to implement their own set of deductions, and I know they don't want to do that. I think they'd rather conform and then have just completely separate Minnesota tax reform out on its own.
Because what's really happening here is Minnesota taxes are gonna go up for a lot of people, not because of a policy determination at the state level that they should go up for
Right.
certain reasons. It's only because of the way federal law changed, assuming they conform.
Right.
And, maybe they do need more revenue if the federal government has decided to shift more responsibilities to the state. But there may be some ways in which the state decides as a matter of policy, it's not fair for some Minnesota taxpayers to pay more taxes because they lost certain federal deductions
Right.
that Minnesota thinks, maybe should be implemented at the state level. Like, for example, maybe Minnesota would want to allow Minnesota's property taxes to be deducted on the state return if they can't be deducted on the federal return.
Right.
And that it makes up for the loss of the federal benefit and, is something maybe that isn't perceived as creating a windfall for Minnesota.
It'll be interesting to see how the session plays out.
So there are ideas kicking around in other states that are maybe a little more concrete at this point compared to what we're seeing from Minnesota. We're speculating more about Minnesota. A lot of the discussion is about helping residents avoid the adverse federal tax impact of the limitation on the SALT deduction by trying to change the state tax structure so that the $10,000 limit isn't reached because an income tax becomes something different. The one you're reading about a lot is creating charitable contribution, treating something as a charitable contribution for federal purposes that in the past would have been a tax. Another one that you're hearing about is a payroll tax increase, where the tax deduction is shifted to federal employers. It's a federal deduction. The other way to address it is to try to lower the state tax burden to make up for the fact that the federal tax deduction is going away. So you've got some bills pending in New Jersey, for example. Property owners can make charitable donations to fund local services for which they could take a credit against property tax. And that would be a state tax credit.
Right.
California has got a bill that would allow state taxpayers a tax credit against their net state tax for amounts contributed to the California Excellence Fund. The impact of a state tax credit is going to be lower because the state tax rates are typically lower than the federal tax rates. So a lot of this really remains for development in terms of, what is the impact of a proposal going to be like on this?
Yeah, and it's really uncertain, I would say, at this point, if a state passes a law that says, we'll give you a credit against state taxes for making a charitable contribution, and then you try to take a federal charitable deduction for that contribution, is that going to be respected as a charitable contribution that gets you a tax deduction? You got something in exchange for that charitable contribution. Right. Usually if you give money and you get something back that's the same value, you would say that's not a charitable contribution. How can you take a deduction for that? There is, though, some law that states have had these types of credits in the past where it wasn't a one-to-one type of a credit. You make a $10,000 contribution to this state fund, and you get a $5,000 credit against your state taxes. So it's like a 50% benefit rather than a 100% benefit. And the IRS has approved taxpayers taking that federal charitable deduction in that circumstance. Of course, it didn't used to matter for the IRS whether they allowed that as a charitable contribution, or otherwise they would see it as a state tax payment, and that didn't used to matter one way or the other for your federal taxes. Now that it matters, we may see the IRS changing their mind, or they may say, well, if you try to make it a one-to-one benefit, we're not going to respect that.
Right.
But that's
Most
still
of the literature
TBD.
out there is written by tax professors, I've
Right.
noticed. And some of them advocate for a one-for-one full coverage rule and say there's authority for that as well.
Mm-hmm. Absolutely.
But it's hard to believe that that the tax agencies and tax lawmakers themselves have grappled with those issues to the same degree as the academics have. So
Right.
it's really, very uncertain
Yeah.
how these are going to play out in reality.
And for states who might think about implementing that, they have to think about where are people going to make those contributions to. If you give them some choices, maybe you don't like what your taxpayers choose in terms of contributions. So,
But giving them flexibility may be key to concluding that it's really a gift
Right.
as opposed to something for which there's a quid pro quo.
yeah.
So we also have just election politics. How is this new law going to affect how candidates campaign for office? And we've got important campaigns coming up both at the federal and the state level. With state taxes going up, I could see people knowing that's going to happen sooner, and so potentially there may be a bigger impact on the state governor's race or in the state house races that are happening, that Minnesota needs to do something. But people won't have filed their 2018 returns until the spring of 2019. So again, a lot of the implications aren't going to be known, and there may not be, many concrete things that people can say in electoral politics. In 2020, there will be a couple of years of people having filed their returns. It will be a presidential campaign year. You'll have all the legislators in Minnesota up for re-election. And then at the end of 2025, we'll see a situation potentially like what happened when the Bush tax cuts expired at the end of 2012, where if everything sunsetted, people will lose a lot of the benefits of the federal rate changes, and mainly the rate changes. And what kind of a burden is that going to put on Congress to soften the blow by keeping some of those changes in effect going forward, rather than having everything revert to how things were done 8 years earlier? I know that in 2012, the main thing that happened was that the Bush tax cuts were repealed, but only at the highest rate levels, and otherwise were allowed to continue. So we will definitely see a lot of action if things haven't been done before then, at the end of 2025.
Well, I think we are reaching the end of our 90 minutes, but just wanted to highlight some of the issues that we'll talk about in the second session at the end of February, which is going to be much more focused on the business level impacts of the act, including the corporate tax rate cut and some other changes, including immediate expensing and the interest expense limitations. Also, we'll talk in a whole lot more detail about that pass-through deduction, including working through some examples. And then in that context, talk about what business structuring looks like in 2018 and going forward, given all of these new tools in our toolbox. Mike Vovis from our benefits group is going to join to talk about executive compensation and employee benefits, and John Hollenreich will join us to talk about the significant changes to the U.S. international tax regime, moving towards something much closer to a territorial system. So I hope you will join us for that. We have just a couple minutes left. We're happy to answer questions. Otherwise, we're happy to stay after too and answer questions in person.
Any questions out there? I can see that you're just saturated
It's all perfectly clear right now.
by everything that we have presented today.
Well, if there's no questions, thank you
Yeah.
for joining us.
Thank you, everyone.